Greetings and welcome back to the podcast. This episode, we are joined by Mr. Dean Popil, Managing Partner and CEO of Lex Capital, a Regina, Saskatchewan-based private equity fund which has invested approximately $600 million the past 15 years. Mr. Popil holds a degree in business administration with distinction from the University of Regina and holds a Chartered Business Valuator and Chartered Financial Analyst designation, as well as a recipient of the Governor-General's Medal of Canada. Mr. Popil has been actively involved in managing private equity and venture capital for over 20 years. Mr. Popil currently sits on the boards of Artis Exploration, Woodland Development Corp., and Point Break Resources. Among other things, we discuss the importance of patience when investing, generating 20% returns, and how volatility creates opportunity for investors. Enjoy. This episode is brought to you by Galatea Technologies. Galatea is a software company based in Calgary that is focused on helping producers better manage their fluid logistics. Galatea enables field operators and truck drivers with the ability to make the optimal decision on every waste, water, or clean oil load, resulting in 20% savings on trucking and disposal costs. The Galatea platform makes it easy to create digital truck tickets, manifests, and shipping documents that automatically flow through the field data capture and finance systems. Galatea's platform is used by over 50% of Canadian producers, 600 trucking companies, and hundreds of disposal locations. Visit galateatech.com to learn more about how to optimize that last line on your lease op. This podcast is brought to you by EVA Software. EVA is a next-generation analytics platform powered by McDaniel Research and tailored specifically for oil and gas to quickly derive insights that matter to energy operators, investors, and advisors. EVA is the only platform that leverages public data, in-house operator data, and exclusive data sets interpreted by professionals at McDaniel Research. This combination allows rapid analysis of the most complete data possible, enabling better decisions around A&D, completion design, and optimal field development. Visit turinganalytics.net to learn more about leveraging EVA to uncover hidden trends, make informed decisions, and stay ahead of the competition. This podcast episode is sponsored by Enverus. Enverus is the world's largest energy-dedicated software-as-a-service company committed to helping customers close the gap between data and value creation. Enverus has been supporting the Canadian energy industry for over 30 years. Visit Enverus.com for more details. Mr. Dean Popil, good afternoon. Thank you very much for doing this. I appreciate your time.
Oh, appreciate you asking me to be here.
For the listener, you're the CEO of Lex Capital, but what is Lex Capital?
Well, we're a private equity firm based in Regina that focuses pretty much exclusively now on energy and specifically on upstream E&P companies. So obviously do a lot of business in Calgary. Calgary is like a second home to me almost.
Based out of Regina, Saskatchewan, if I'm correct.
That's right. The only one.
Do you guys reference your AUM or is that proprietary?
We're not an evergreen fund manager, so we're constantly raising new funds to replace other funds where we're selling companies and distributing that capital back. But I think the key is over the last 15 some years, we've raised a little over $600 million to be invested here in Western Canada.
How'd you get into investing?
Going into university, my plan was to be a lawyer. And I had thought about being a lawyer for a very long time and then got into probably my second year of university and started taking some finance classes because I was going to get a business degree first and then go into law school. And I really, really enjoyed them. It was kind of hey, maybe the direction I'm headed isn't where I should be. And if this is what I enjoy, I could see myself doing this. And so engaged a lot with some of the profs and, really immersed myself in the finance world a little bit and got some mentors in the industry. And long and behold, I decided rather than pursue law school right after I was done my degree, I would take a job. And I ended up getting a job, entry-level analyst at a venture capital firm based in Regina. And I thought, you know what, worst case, I do this for 6-8 months a year. And if it doesn't pan out or I don't enjoy it, law school is always there. Then I loved it. I absolutely loved it. And I found a passion for it. And I remember after a month in, I just, called my parents, said, found what I'm going to do the rest of my life. So that's how I got into investing more on the private VC type side. So I wasn't managing public funds, but very much investment thesis is across a broad spectrum, and really enjoyed that I got the opportunity to take that path.
You're also pretty young to be managing a sizable fund, so things are going well.
Well, I appreciate that. My partner, Craig at Lex and Curtis, Craig always says he's the gray hair in the group. And I do, he always mentions that I look older than what I look. So I am older, than what I look. So yeah, appreciate the compliment. Thank you.
Why energy investing?
Well, interestingly enough, so when I took my first job, it was with a company called Saskatchewan Government Growth Fund. That was an immigrant investor program. A lot of people didn't know about it, but back in sort of the 90s, 2000s, people want to migrate to Canada actually could invest in these funds in different provinces that hosted the program. And then those funds were professionally managed by BC managers. And so it would fast track their immigration to Canada and get through their process quicker. And then it created a pool of capital that could be invested in early stage companies and grow the economy, and would be a huge benefit to the province. So I start this job, new analyst, and this is, 1999, 2000. The CEO at the time comes up and says, well, we're seeing a lot more oil and gas opportunities in Saskatchewan. These guys are doing, these startup oil companies, and oil looks kind of interesting. We don't know anything about it. And so one of the partners there had some experience with it, but not a ton, and basically said, hey, learn the oil industry. So I'm a finance guy, right? I know nothing about permeability and porosities or geology, but I just immersed myself at that point, asked a million questions. We had some consultants come in and help us develop a bit of a strategy. So I learned energy from the ground up as a finance individual, right? With no formal training. So you just roll up your sleeves and figure it out. And so I became sort of the go-to analyst in the shop whenever we were looking at an oil and gas deal, would pull it apart, do the due diligence, and help develop a recommendation for the senior partners to invest in it. And so there's no better way to learn by just rolling up your sleeves and actually doing it.
Do you have an investment style? Maybe patient capital, value investing, fast money, momentum?
Fast money would be a bit of an oxymoron in our business. Patience and discipline are huge. One of the principles of our firm is having skin in the game, whether it's, in an oil and gas or any type of opportunity. And sometimes it's not the dollar amount that's important. Someone who's worth $50 million and they're putting $1 million in this next company and they're a founder, that's to us may not be as important as someone who, might be in their 30s and 40s and they come up with $500,000 and that's like half of their net worth and they still got mortgage payments and car payments and everything else. We know they're committed, right? So we look at it as a percentage of net worth basis rather than an ultimate dollar amount, and how meaningful it is, because at the end of the day, they're the ones steering the ship. If nobody's steering the ship, I don't want to be on the ship. So you want to have complete confidence and know that if things don't go well, they're worrying about it as much as I am. So that definitely is a principle that's been ingrained in us at our firm. We focus on the private space as opposed to investing in public companies. We'll dive into what's your net worth, what percentage of your net, demonstrate how meaningful your investment is. What's your adjusted cost base? Are they investing in that company at the same level as investors? Like, is there alignment that way? I find public filings, it's really difficult to see how much or what hard dollar investment that the executive team has, what their cost base is relative to the current trading price. So those are things, you have the luxury of asking and finding out in the private space that you don't in the public. And so, like I said, it's definitely a principle that's driven. I think, a lot of people talk about it, but definitely at our firm, it's something we take very seriously. And a lot of that comes from Craig. I mean, Craig Lothian, who's my business partner at Lex Capital, he created 5 oil companies in a period of, I think, 11 or 12 years. In fact, one of the first investments I ever worked on was one of the companies that Craig started. And that's how I got to know him, was being across the table from him. And in each of those companies, he was the largest individual shareholder. And so, we knew he was committed. He was going to make as much off his investment when it worked well than he would off incentives like options and warrants and those type of things. And in fact, he created them so quickly and was selling them so quickly during that period that he had investors call him, were upset saying, could you not hold on for another 4 months so we could get our personal capital gains exemption? And, capital gains is something that obviously is in the political sphere right now and is a hot topic, but you sell when you sell. And so when you're selling companies in, a period of 16, 18, 19 months, you're not thinking about, the tax consequences. You're doing it for business reasons and was very successful at that.
Do you view investing out of Regina as a advantage for the firm? Although there's a lot of energy activity in Saskatchewan, it's not the center, aka Calgary. Do you see that advantage?
No, that's an interesting question. I don't necessarily think we're at an advantage per se. Like there's a lot of private equity shops in Calgary, guys that we have really good relationships with and have invested alongside. They're all really smart guys. And, I've had really good experiences with them. One of our advisors, Don Black, was one of the founders of Greystone in Regina. Greystone is a pension fund manager that, manages public sector pension funds and private funds. Don and the executive team, he put together a bunch of, super smart individuals, but they grew that firm from 100 million to 34 billion in Regina. And I remember Don saying to me, nobody thought they could do that outside of Toronto. And they're like, if you're going to be an asset manager, you have to be in Toronto. And his view at the time was, look, there's a bit of a herd mentality in Toronto with all the different investment funds and hedge funds. So we want to remove ourselves from that and take an independent approach. And long and behold, they had tremendous success. And I think they sold to TD 2-3 years ago for a fairly significant amount. And so I think a little bit of that philosophy plays in our respect as well. But again, don't think we're any smarter than anybody else. We're just a little bit removed out of the Calgary center. I come here to energize. It's a great city. But, Regina, Saskatchewan was kind of a flyover zone from people, Vancouver, Calgary, going to Toronto. And then with Greystone and Lex and other firms, people actually come to Regina to present their ideas. And I think one of the other things too is, I'm a 45-minute drive to the nearest pump jack, right? Like we're pretty close to the field. I chat with those field guys pretty regularly. These are the guys and gals with dirt on their hands. They're working long hours. I think tremendous amount of value is created by the boots on the ground folks. And I certainly don't think they get enough credit. Of course, the CEO is the leader of the company and is accountable for that. But these are the folks in the field that are away from their families for extended periods. They're on the rigs and they really make this whole industry work. So executives that really take care of their field folks, those are the partners we really like to invest in. And so, like I said, being in Saskatchewan, I'm pretty close, whether it's Estevan, Weber, and Carlisle, full of great people that make this industry work. So maybe that connection sets us apart in a few ways.
Decentralized, kind of like Warren Buffett in Omaha, or Charlie Munger used to work out of an office in Los Angeles.
Yeah, perhaps. I don't know if I'd mention us in the same sense as some of those legends, but sure, maybe the concept's the same. Yeah.
To start from the top in terms of energy investing, what makes a good energy investment to you?
We spend less time worrying about like a macro point of view. We really focus on more at the company level, good asset. We're going to be investors in the space, whether oil is $50 or $100 a barrel. We need to find ways to make money, right? And so we partner with teams that, for the most part, track records of making money throughout different cycles. There are teams that have made great wins for their investors back in when oil was $40 a barrel. Very different time, obviously, but trying to time it and pick it on the cycle, well, that's tough to do. Timing is really difficult to beat in our business. So we look for teams that are committed, obviously skin in the game as I talked about earlier, have strong technical backgrounds, strong track records, but we do try to find the balance between a strong team and good assets, because, there are teams out there that have done incredibly well in the past, and then, they'll have a flop. One of their companies doesn't do so well. And that comes down to rock, to geology, right? You can't change the rock. So we do spend, as a firm, quite a bit of time looking at the assets as well as the team. And you try and find a balance between a really strong team that's hungry and committed and convicted, but at the same time is in the right area code and, we focus on single well economics and make sure that their plays work and they're going to be able to roll up their sleeves and actually make that asset into a good one to sell. Right? Because at the end of the day, we have to sell an asset to someone else, either a public company or a larger private, in order for us to gain liquidity. And if you don't sell something good, you're not going to be in business very long. And so we make sure that when we're investing, we spend a lot of time evaluating what are we trying to achieve? Like, what are we trying to sell in 3-4 years? And what's that going to look like? And what does this team need to accomplish to get it there? And that in a nutshell is kind of how we look at everything. So again, just spend a little less time, worrying about geopolitical events or what the White House is going to do with SPR releases. And for everybody on Twitter or in analyst shops, everybody's got different opinions about where oil prices are going to go. So we try and be somewhat agnostic as to where oil prices are going to go and look at it like, okay, well, how do we manage that risk, right? Whether it's by hedging or being in a very economic play where if oil prices go down, our break even's lower than most of the base. So we'll be the last one to shut off our pump type of thing. So that's the way we've approached it, probably more of a micro level as opposed to more of the macro managers out there in the space.
For the investor who has a buffet of options in front of them, some would say the ultimate hurdle rate is the risk-free rate coming from the U.S. federal government all the way up to whatever risky investment you want to say. What would Lex Capital's value proposition be to the investor who has options? Do you have a hurdle rate that you present to people, or how do you think about that?
Yeah, I mean, when we're looking at an investment, we're targeting sort of a mid-20s% IRR, right? So 20 to 25% a year compounded, looking at a 2 times money in 3 years or 3 times in 5 years. If we can forecast that based on risking management's numbers, so we take management's forecast, what they think they can achieve, we apply a pretty conservative price deck going forward. If we can get a base case that's in that range, then that drives our investment thesis. Now, if management hits their numbers and they hit their targets, which often does happen when you're investing with great teams, then there's upside to that. So, we don't present an investment recommendation saying, it's dependent on triple digit oil prices, right? Even though we are a triple digit in Canadian dollar terms, certainly, we're not dependent on that, right? That's what's great about this business. There's always this potential upside of a super cycle and everything else, but we don't let that sort of drive our investment ideas at all. It's more driven on an asset level basis, if that makes sense.
When you're valuing basically everything from a widget to a business and the resulting stock, you need to determine value to figure out what you're buying, how you're going to get a rate of return. And the idea is sometimes to buy undervalued securities and sell them for a higher price. From your perspective, how do you value an oil company? Does it start at reserves and you kind of work into the intangibles? Where do you go? How do you think about that?
Yeah. And we're not entirely acquisition driven, right? So a lot of our teams are ground up type of opportunities where we'll capitalize the company with $30-40 million. They've got a bit of undeveloped land, maybe 100-200 barrels a day of production. So the valuation of the initial sort of asset package is less important to us as opposed to the prospectivity of that asset, right? Is it a new emerging area? Is it an area where you're applying new well designs and technical knowledge and know-how from another part of the basin and applying it here? And if it works, what does that look like, right? And are we an earlier, one of the low-cost entrants to a new play? Those sorts of things come into our thinking as opposed to being purely acquisition-driven. Now, having said that, we love when teams come to us and say, hey, we've got an acquisition, we're buying it for these metrics. And, we can take production, say from 5,000 barrels a day to 10,000 barrels a day with some low risk delineation development type of thing. Those opportunities are great. But again, typically they're competitive, right? Competitive process. So, When a team comes knocking on the door and saying, we were the high bidder and we got this asset package, you got to step back and say, why were we the high bidder? Right. And every part of the basin's unique. It's hard to say, yeah, we won't invest unless you're buying it for less than 2 times cash flow. Well, an asset in the Clearwater may be very different than what an asset in Southeast Saskatchewan is worth. And so it's driven by the asset. There's no magic formula or set of parameters. I think, you lean on business experience that we've had and our investment experience. And I think we've shown that we've been very disciplined. Our funds have had a lot of success. And I think that speaks more than trying to kind of slot hole different things of what we need to buy it. So I would characterize, Trevor, us more as a growth investor as opposed to value. And, to a certain extent, we definitely don't want to be out there overpaying for stuff because it's got a huge growth trajectory. But at the same time, we're more focused on what this asset could look like and the steps to get there in order to generate that return, rather than trying to grind away another half point on the multiple.
Everybody wants the next Clearwater nowadays, but it's almost too late. So how do you balance that with finding the next Clearwater? How do you go about doing that?
Yeah, I'm actually amazed at some of the teams in the basin have done with emerging pools, like with Spur and the Clearwater. I've been in the business long enough, been doing this for, almost 25 years. And just when you think we're tapped out, there's no new plays, resource plays happen, or the Bakken and Southeast Saskatchewan. Everybody knew the Bakken was there, but nobody drilled into the Bakken, right? And there are guys that held land over the Bakken and never drilled a well and didn't know what they were sitting on at the time, right? So again, whether it's Spur in the Clearwater, Tourmaline, Anegada, Archer, exploiting the Charlie Lake, the Manville Stack, new play in central Saskatchewan, Alberta, small scale thermal plays that look interesting. Teams are smart. They're getting smarter. They're more innovative. And I think they'll continue to find new areas to recover more oil. And maybe, we're not looking for unicorns, pools of oil that try and go out and drill in northern Saskatchewan, but finding places where there's big oil in place and changing the way we approach it, whether it's well designed, whether it's fracking tighter rock, meshing zones instead of chasing channels, whatever the situation might be. I'm amazed at how technical this business is and how innovative people are. I don't think the public market appreciates how hard it is to find and extract oil economically. I think smart people in Alberta and Saskatchewan make it look easy, but it isn't. It isn't easy. So I think a lot goes into it. So I'm pretty optimistic that people are always going to find new opportunities in this basin. We're blessed with an awesome resource here in Canada. I think we've got a lot of running room to find new emerging plays.
Just a quick thank you to one of our sponsors, and we'll be right back to the show. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. To be an investor requires capital. It takes money to make money. Lex started with Mr. Craig Lothian's capital, but how do you think about bringing in more money to the firm? And it's bittersweet when you grow sometimes. The law of large numbers makes it harder. Are you bringing in new capital? Do you like to keep it small? How do you approach that?
Yeah, well, our last fund, we capped it at 200 million. So we set out a target of 200 million. And as soon as we hit that target, we capped it. But our first fund was $36.5 million. And it was raised from, I think 80% of our investors were Saskatchewan-based high net worth individuals, accredited investors. And now our last fund, that was 200 million, 70% of that came from US-based investors outside of Canada. And our approaches have been a little bit different. A lot of the funds in Calgary were raising large amounts from pension funds, endowments, foundations, both in Canada and the US and even Europe. But with ESG coming down the pipe, a lot of those pension funds, certainly the foundations and endowments, have 100% pulled back and just will not commit any more capital to this industry. And, I talk to portfolio managers all the time in this space and, they're frustrated. They see the compelling opportunities in the energy space and especially Canada, but they're precluded from investing. Where we spent our time was with the high net worth group, the family office group that they're more nimble. They're not hands tied by ESG. They can move very quickly. They buy into the investment thesis and they're there for economic returns. But that's 10 years of relationship building. A family office is, a difficult investment to get unless you spend time with them. And, those that said no to us in fund 1, 2, 3, are putting anywhere from 20 to 50 million in funds 4 and 5, right? So it took a long time to build that network and to build that, but now we've got a great supportive group of investors that are mainly in the US, some in Europe, and they're interested in investing in the energy space in Canada. So I think that has definitely helped us. So most of our capital now is actually not from Canada, not from Saskatchewan, but from outside investors that have spent the time to get to know us and like what we have to say and like our approach.
Are you seeing renewed interest in traditional energy, or has the Lex brand grown to attract the capital from the US? Is it a combination of all of that, or?
I don't know if the Lex brand has grown. I think we have many of the same investors that have, they keep re-upping with us and they keep wanting to increase their exposure to the Canadian energy space. I think as a US investor, you're looking at a 72, 73 cent Canadian dollar. Their money's going that much further. They understand the space. They're not new to energy, and they look at the US space and the metrics and the value down there is a lot. They're trading at much higher values or much higher metrics than their Canadian counterparts. And when they start to drill down on a more granular level, you start to look at decline rates around the basin, and Canada generates a significant amount of free cash flow as a whole. The energy patch does at this level, right? Oil prices are referenced in US dollars. So you transfer that to Canadian dollars with a depreciated currency, and we're enjoying $100 Canadian oil, the highest price we've seen in a very, very long time. And operators have gotten more efficient. So costs have come down and, our capital efficiencies are improving. So when you look at all that, I think Canada's got a very compelling case why you want exposure here. Now, some investors have been talking about that for a very long time. And, the valuation discrepancy between the US and Canada still remains. And will that spread last forever? We don't think it will. I think it'll narrow over time, but Canada's had a lot of headwinds, political headwinds, pipeline issues. Investor sentiment has definitely been sour for a while in the space and in Canada. But I can tell you that I've gotten more phone calls over the last, say, 12 months from US based investors looking to get in and having something professionally managed than I have in the last 10. So that's completely anecdotal, of course, but I think, maybe the interest is starting to change a little. And I think, if you look at the US, their regulations are really starting to clamp down on the US fossil fuel industry, right? So they're getting a taste of what Canada's been through for the last, what we've had to deal with for the last 10, 15 years. So if they're looking and saying, wow, the US energy space is valued at, up here and Canada's down here, but yet we're getting these regulations, we're getting hit with EPA's getting more teeth, whatever it is that's happening there. Maybe we see a bit of a capital flow trickle into Canada as a result. And again, completely anecdotal, but that's sort of how we're starting to see things right now.
Protecting the downside in energy, it's traditionally a pretty volatile business. Do you take a portfolio approach to the companies, or do you concentrate pretty heavily? How do you think about risk?
A lot of investors will call me and ask, how do you manage the downside? And when you look at our funds, some of the early funds didn't fare as well. And unfortunately for some of those funds, we were investing in sort of 2009, 2010, 2011. And then when we were going to sell companies in 2014, 2015, we all know what happened, beginning of a 7-8 year downturn in the industry. So those funds suffered, but the losses were very minimal compared to others, especially, we look at some of the US funds where there's tremendous amount of capital loss. We sort of minimize that. So when we look back over a cycle where things were as bad as they could have been for the industry and then hit COVID, our companies managed to survive. And in fact, one of the things, I'll dive into a bit of a story here around epiphany we had during COVID, but being well capitalized and having enough dry powder, both at the fund level and at the operating level, you can either see things as a draconian day where oil prices are crashing, or you can see it as an opportunity. And we choose to see it as an opportunity. And I'll tell you, so during COVID, oil's 40, 30, 20, and it's 15. And so I call one of our CEOs and say, let's pool a couple $1,000,000 and let's just buy some oil. I'm sure we can find storage. There's tanks all over the place. Let's store oil. And at that time, we were thinking, let's buy oil for $15 a barrel. It's got to go back to 30 or 40 because anything below that, like the industry outside of very few places in the world just doesn't work. Like it's shutting down. Like the world is done. And COVID, we're in the midst of COVID, everybody's locked down. We're still consuming like 70 million barrels of oil a day. So we go down this path. We get permits done. We source some storage tanks. We can buy a couple 100,000 barrels of oil. So we got this all lined up. We're thinking we're geniuses. And we go out to try and find and buy some oil. And we could not source one spot barrel of oil anywhere. I was calling guys throughout Southeast Saskatchewan and say, right now prices are $15 a barrel. I'll give you 20. We'll give you 20. All you have to do is our truck will come pick it up and we'll take it to the storage facility we've arranged for. I couldn't get one barrel. And companies were like, look, we're either shutting it in or we're just going to fill our own storage tanks first. We'll finish our contracts with Plains or whoever we have for the minimal amount, but then we're not selling any more oil. So it was kind of an epiphany where it's like, okay, if I can't buy a barrel of oil at $15 a barrel, is that really the price? There's the physical market and the paper market. There's a huge discrepancy. And so if I can't physically buy a barrel of oil, but the next day or a week after they're telling me it's negative, it's like, you know what, guys, we need to roll up our sleeves and invest as much as we can right now because the paper market's gonna have to converge to where physical barrels are going to be traded again. So, the money that our companies invested and the money that we invested during that period obviously was delivered huge returns for us and generated significant gains for us and our investors. I wish we had invested more. But again, our investors calling their capital in the midst of a pandemic. And, a lot of guys calling me saying, oil is dead. What are you doing? You can't put more. And we viewed it as more of an opportunity. So we always tell our companies, look, be prepared for volatility and downturn. But if we get some of those troughs, like that's the time to invest. And throughout COVID, we had a number of our portfolio companies that kept drilling. Right? The services weren't busy. So they were willing to drill. The frac crews were coming out at discounted rates and we were able to continue to grow production. And then once things started to recover and really sort of react in 2021, 2022, we started selling those assets when oil went up. And so, we liquidated a fair bit throughout that environment. So again, our philosophy is a bit more, hey, if oil prices go down, that's an opportunity for us as opposed to a threat. So, we manage the risk by being under levered and well capitalized and prepared.
Interesting to hear that somebody actually took advantage of that.
Yeah. And we were doing lots of secondary. I remember brokers calling us saying, we have Spur available at $7 a share. It was a private company. And, their shares have been consolidated, but that was incredible opportunity, right? And so, we actually did quite a few secondary transactions. We had shareholders in some of our private companies that called us and said, I'm out. I don't know where this industry is going, but the world's ending. I want to sell. And so they basically offered up shares and we said, sure, we'll buy as many as we can. We believe in the company. We believe in the team. None of that has changed. So if it takes 2 years, 3 years to recover, we're prepared to do that. Like I said, in hindsight, I wish we would have done more, but of course, hindsight's always 2020.
The universe of Canadian energy companies is relatively small. Once you've placed your bets, what do? Do you spend your day looking at new companies, or is it a don't just do something, stand there kind of philosophy?
I believe life is too short to spend time with people you don't enjoy. So, a lot of the teams we invest with, they're great people. We sit on their boards. We do things outside of business together and really enjoy that. So we definitely have good relationships and spend a lot of time with our management teams. We're not there day to day. Don't get me wrong, but from a value perspective, we like to sit on the board. We like to put a lot of input into board composition. So instead of putting, 3 guys from Lex on a board, we'd rather, suggest whoever it might be that has a good geology background that we know and has great business sense, or a geophysicist that we like that knows this area really well. And so I think, we add value through that. And over the last 25 years, I think we've been involved in the sale of, 30 plus companies. Craig alone has sold, 5 or 6 companies, one royalty company a couple of years ago. So there's a lot of experience there on the M&A side, on the sell side, and what it takes to actually sell a good asset and to help negotiate and navigate, all the ins and outs with that. So I think we definitely help out on that side of things. And honestly, the only time that we consistently disagree with some of the management teams we've invested in is on the sale. Teams just tend to, and I get it, right? They're passionate about what they're doing and they're passionate about the asset they're developing. And so it's easy to fall in love with your asset and think it's worth more than what the market is willing to pay. Our view is the market, right? And the market's not wrong. If go through a competitive bid process and the buyers are prepared to buy your asset at this price, then that's what somebody's willing to pay for it. And so, there's lots of toing and froing and maybe some disagreement around valuation, and let's just hold on for another 6 months and maybe, the market will improve, but you're taking so much macro risk by doing that, right? You saw everybody thought we were in for an awesome super cycle a year ago, or the narrative around that was there. And all of a sudden the US decides, hey, we're going to release 250 million barrels of oil into inventories and inflate them. So, and the policy worked. It actually, to their credit, the White House's credit, that actually worked. And so did anybody see that coming? I don't know, maybe a few theorized about it, but if you wouldn't have sold and held on, you'd actually be worse off. The value of your company would have gone down. So our view is that, look, when it's time to sell, it's time to sell. And sometimes you may not be selling in a frothy environment, but when the asset is ready and looks attractive and it's a good fit for someone else, then it's time to go. And hey, if you believe in the upside, then lots of public companies are willing to do share transactions. You hold on to their shares and ride the upside of that asset under a bigger umbrella within a public company and more diverse asset base. So yeah.
Maybe a couple thoughts on current events. I guess maybe capital gains tax. In simple terms, recently capital gains tax was raised for high income earners. Is that good or bad?
Well, obviously capital gains is a hot political issue right now. The current government's trying to frame it like it's a tax on the wealthy, but to think it's not going to have an effect throughout the entire economy and everyone from low to high income earners would be very naive. You're targeting professional corps, family doctors, corporate business owners, entrepreneurs. I mean, these are major employers across our country, right? And, they're typically incorporated. That's what most people do. They don't have, when you're investing personally, the government's touting that your first $250,000 gains doesn't change. Well, most of us have invested through incorporations, right? Like most businesses incorporate. So, and most doctors run it through professional corporations, right? They have to pay their office staff, nurses, their rent, lease, or whatever it might be. So it is punitive from an entrepreneurial point of view and a business owner point of view. And a lot of those, they don't have a defined benefit plan that's funded by the government. So I think it is disproportionately punishing people and business owners, people with entrepreneurial spirit. The reality in our business or any private equity or venture capital fund is we're investing at an early stage for growth. These companies are starting from the ground up. They don't have cash flow to pay dividends. So you're investing to generate an eventual gain on a sale down the road. So there's no question it's going to hurt our business and any early stage companies. And you can see Canadian Venture Capital Association has weighed in on this. And our Canadian investors, they're going to say to me, well, Dean, I could invest in something lower risk, right? That pays regular dividends, because when they assess returns, they do it on an after-tax basis, which is the proper way to do it, right? The cash in your jeans is what's important. So you have to look at taxes as part of your analysis. And it definitely is going to hurt companies like ours and funds like ours that are investing and promoting early stage growth funds that are creating new jobs. I'm honestly, Trevor, I'm glad most of our investors are US based because, they're subject to a much more reasonable after-tax return profile. And since our Canadian dollar continues to depreciate, I guess it also makes it attractive from that perspective. But it definitely, I don't feel that it's going to be good for the average Canadian or for our economy. So hopefully things will change here over the next couple of years politically. People say Brian Mulroney and the Conservative government, they increased capital gains tax back in the late 80s, early 90s. And I'm shocked to hear it. Do they have any idea what the late 80s and early 90s look like for the Canadian economy? Take a look at it. It wasn't exactly a robust time for anybody. So if we're modeling it after that, I think we're all in a lot of trouble as Canadians.
What does it mean when capital is mobile? Investors have options, and so when they have a higher tax rate in Canada, they can maybe go to the States. But do you see that? What does that mean when capital is mobile?
There's no question it's mobile. We saw that throughout the last cycle. One of the challenge for the Canadian energy space in the private side, I'm because that's where I spend my time, so I'll speak specifically to that, was liquidity. So we had teams that actually did really well on an operational basis. They continued to grow production efficiently and everything else. But when it was time to sell, there actually wasn't any buyers. No public companies were transacting because they were trading at depressed multiples. And so a lot of our US investors at that time, some of the larger ones that we had been talking to, said, we want energy exposure, but we're going to reallocate it to our US type based companies because there's liquidity there. There were actually assets still transacting and at reasonable multiples, where in Canada, we weren't seeing a robust M&A market. And even, right now you're seeing the M&A market in the US is definitely way ahead of where Canada is. It's starting to pick up here up north, but we're still a far ways away from the $100 billion transactions we've seen south of the border. But definitely capital, they didn't like what they saw here in Canada and they moved. And they're looking at differentials, right? Like we've had pipeline issues and massive blowouts and discounts on Canadian oil because we haven't been able to get it out of the country. I remember we sat down with a Texas-based investor and they were looking at writing a $30 million check for our fund. And portfolio manager spent a couple of years getting to know us. We were now raising a fund. So we went down to Texas and had a sit down with their entire committee. And it was really it was very positive. It was moving forward. They're in Texas. They understand the oil and gas business as good as anybody. And then it went to basically, their executive committee. And one of the very vocal committee members basically said, I'm not taking pipeline risk. I am not taking Canadian political risk. So portfolio manager calls me and you can tell he's kind of down because he spent a lot of time doing due diligence and buying into our thesis. And he calls me, he's like, Dean, we can't invest. One of the influential committee members is just like, I'm not taking the risk of investing in Canada right now. You've got all these different, and at that time, Enbridge Line 3 wasn't operational, their expansion, TMX was a mess and everything else. So their view is until there's some certainty around that, we're going to pull back and we're going to say no. So very disappointing that something completely out of our control, it's out of the control of anybody operating in the Canadian energy space, political hot button, is affecting our business and is affecting capital. So policies matter. Policies matter.
Do you think there's room for any more energy funds in Canada, or is you, Canoe, and 9 Point enough?
Well, those guys they're really smart guys, have a ton of respect for them, but they're focused more on the public market guys, right? And we're focused more on the private equity side. And there's still a lot of firms that are very active and really, really good people here in Calgary that still run funds. Whether there's room, I think there must be room because we've started to see US and large US private equity firms enter this space. And let's say 5-6 years ago, they were not here. They were here 10-15 years ago, completely pulled back, said, we're done with Canada, wiped their hands clear. And then up until the last, I'd say maybe just before COVID, we started to see them active in our space again. So if that's any indication, those are sophisticated institutional investors. So if they're starting to look at Canada on the private side, I think it's only a matter of time before, the big public company managers start to look at Canada and the value proposition we have here.
It is April 25th, 2024. Maybe to leave the general investor or energy investor a final message, what would you tell them?
Be patient. I mean, patience is a virtue, but this sector it's a fun place to invest. It really is. It's full of really good, smart people that care about the environment. That's a big topic. They care about the environment, but they're good at what they do. And everybody talking about peak demand, 2030, 2035. I obviously think that's nonsense. I think we're going to continue as a world to continue to consume the molecules here. So Canada has, not only great people, but we're blessed with an awesome resource. So continue to have faith in this sector, continue to have the faith in the people that are active in this space. I think we're going to outperform. But for those looking to get rich quickly, those opportunities during COVID and stuff, those are rare. To me, it's more the patient, disciplined capital in the space that's going to outperform the broader market. So I would just say and leave everybody with the thought that Canadian energy is a great place to be. Hopefully you continue to invest or think about investing if you're considering it right now.
Well, that's awesome. We can end the formal conversation there. Thank you very much.
Okay. Thanks, Trevor.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.